Welcome to the Deep Dive. We're here to cut through the noise, really get to the insights that matter most for you. Today, our mission, our focus, is distilling the key frameworks, the really crucial lessons learned from a very valuable recent discussion between Raoul and Jamie Couts, two top financial analysts. We're zeroing in on the crypto markets. How do you navigate this current landscape with, let's say, more clarity? And what came out of the conversation really loud and clear was this central thesis, global liquidity. It's arguably the single most important kind of overarching driver for crypto. And we're not talking casual link. The data they discussed shows an extremely high correlation. Think 88, maybe 90% correlation between global liquidity and Bitcoin's price. It's almost uncanny how tightly they move. And this isn't just, a fun fact. It's foundational if you're in this space.
It really is foundational. And what's fascinating, digging into what Jamie Couts presented, is that this correlation isn't always, let's say, linear. His model suggests Bitcoin's sensitivity to liquidity changes. And that brings us to what he calls these super bullish liquidity regimes.
Super bullish liquidity regimes. Okay, what does that actually mean?
Well, think about periods where global liquidity isn't just expanding, but it's expanding rapidly, especially after it's been tight, after a contraction. It's like compressing a spring really hard and then letting it go. The resulting force, the impact, is just magnified, way beyond what you'd expect from just a gentle push,
Okay, so it's about the rate of change after a squeeze.
Exactly. And the multiplier effect is pretty staggering. So normally, Bitcoin might rise, say, 7% for every 1% increase in global liquidity. That's kind of the baseline. But in these super bullish periods, that multiplier, Couts suggests, can jump to 20, even 30 times.
20, 30 times.
Yeah. So that same 1% liquidity rise could suddenly lead to a 20 or 30% jump in Bitcoin's price. It's a huge amplification.
Wow. And is there evidence this is happening now?
Well, they pointed to pretty powerful recent evidence. Back in early April, there was this clear breakout in global liquidity. It was only about a 2% increase, fairly modest on the face of it. But Bitcoin rallied a full 40% around that time.
40% from just 2% liquidity.
Precisely. It really seems to validate this amplified sensitivity, this nonlinear impact when you're in one of these regimes.
That's a really crucial point, because I think for a lot of people listening, seeing Bitcoin near or at new highs, the instinct is it must be overheated. But what you're saying, based on their analysis, is maybe not because of this regime. What makes it so different?
Exactly. You can't just track liquidity levels. You have to understand this potential for a nonlinear response, especially coming out of a contraction. What makes it different is that the market's effectively been starved of liquidity. So when that constraint eases and money flows back in rapidly, the impact is just much greater. The market's thirsty, so even a relatively small amount of liquidity has this profound effect. So yeah, based on these metrics, the analysis suggests the market isn't overheated. It's actually performing as you'd expect within this super bullish phase.
Okay, so it's doing what it's supposed to be doing, given the conditions.
Yeah.
That definitely provides a clearer lens. So liquidity sets the big picture, the macro stage. But markets can still get ahead of themselves, right? Even with plenty of liquidity sloshing around. That, I suppose, is where Jamie Couts' three-part risk model comes in. To give a more nuanced view, looking at behavior, leverage, like an early warning system.
That's exactly it. If liquidity is the main driver, what else matters? What signals a top or deviation? That's what Couts tried to capture with this three-dimensional framework. It goes beyond just the money flow. It gives you this more holistic view of, let's call it market health. We should probably break down each part.
Yeah, let's do that.
Okay, first up is the liquidity risk score. Think of this one basically as a valuation tool. It measures how stretched Bitcoin's price is compared to the underlying global liquidity trend. It's a 1 to 5 rating system. They mentioned it has granular percentiles too for more detail. But the core idea is simple. Is the price running too far ahead of its main fuel source?
And how do you read that score?
Well, scores below 4 are generally seen as neutral, sort of normal conditions, maybe fair value relative to liquidity. But when that score hits 4, that's a signal. Time to maybe consider taking some profits because the price is getting stretched. They gave an example, actually. Early 2024, Bitcoin around, 51, 52,000? This score apparently flagged it as stretched. And sure enough, a week or two later, it topped near 73,000 before pulling back.
So it's not predicting the exact top, but it's saying, hey, we're getting extended here.
Exactly. It's a warning sign based on that fundamental liquidity driver.
Okay, what's the second dimension?
The second is the derivatives risk score. Now, this one's all about speculative froth. leverage. It mainly looks at perpetual futures, those contracts letting you bet on the price without holding Bitcoin, but also considers options activity.
Right, the leverage.
Yeah, and this score is particularly good at flagging market tops, apparently. They saw it spike in early 2024 around the ETF launches and again in December 2024. Because when you have excessive leverage, as this score shows, it just amplifies risk. Market becomes much more fragile, unwinds happen faster, sharper.
Like being on roller skates, you said earlier.
Kind of, yeah. A small push can cause a big fall. If you're already stretched on the liquidity score and leverage is super high, that's a much more dangerous combination. Any dip can trigger cascading liquidations. Much nastier.
Makes sense. And the third part.
The third is the network profitability risk score. This one shifts focus to on-chain data. It's looking at the behavior of actual spot holders. It blends together several metrics, things like MVRV.
Market value to realized value.
Right, basically the network's overall unrealized profit or loss. Also NUPL, net unrealized profit loss, similar idea. And SOPR, spent output profit ratio, which shows if coins being sold are moving at a profit or loss. Together, these paint a picture of on-chain sentiment, how much profit is embedded in the network. And crucially, are the long-term holders starting to sell en masse? Because historically, that often coincides with major tops.
So it's tapping into the psychology and actions of the actual coin holders on the blockchain.
Precisely. Are people sitting on huge gains and getting tempted to cash out? This score tries to measure that collective state.
Okay, that's a comprehensive framework. Liquidity context, derivatives leverage, and on-chain holder behavior. So bringing it all together, what are these scores telling us right now according to their analysis?
Well, the current readings are actually quite interesting. According to the discussion, all three risk indicators are currently sitting at neutral or even low levels. The liquidity risk score and the network profitability score are both apparently at a 3 out of 5. That's neutral territory, no major red flags. And the derivatives risk score, the leverage measure, they described it as pretty low.
Pretty low, even with Bitcoin pushing all-time highs.
That's what the analysis suggested, yeah. Which implies that despite the price action, the underlying market structure isn't showing signs of excessive speculation or leverage building up yet.
So what does that mean for you listening right now? I mean, these low to neutral scores sound pretty significant. Does it suggest the market actually has more room to run before things get genuinely overheated? Less risk of those sharp headwinds from everyone being on one side of the boat?
That seems to be the implication, yes. It suggests the rally has substantial room to potentially continue without hitting those immediate danger zones flagged by the model. The current strength seems, based on this framework, to be built on a more solid foundation tied to that liquidity regime, rather than just pure, unstable, speculative frenzy.
Right. It suggests the market isn't necessarily on the verge of falling off a cliff.
Yeah.
By these measures anyway, there's still runway before serious warning signs flash. Okay, so that covers Bitcoin's macro picture and the risk assessment. Now, the million-dollar question for so many people, what about the altcoins? Is an alt season really happening within this bullish environment? And crucially, will it look like past cycles where, pretty much everything just went up?
Yeah, that's always a big question. And the discussion between Raoul and Jamie really highlighted something important here.
Yep.
While you typically see a lag Bitcoin moves, then alts follow this cycle's alt season seems different. The expectation they discussed is that it's going to be much more selective this time around.
More selective, meaning not everything pumps.
Exactly. And the key insight isn't just that it's selective, but why. The analysis suggests the market is finally maybe maturing a bit. Moving beyond just pure hype cycles, the greater fool theory might be taking a back seat to actual demonstrable value.
So investors are being more discerning, looking for substance.
That seems to be the idea. Capital appears to be focusing more on projects that can show strong fundamentals, real network growth, actual economic activity, not just narratives and speculation. They talked about a shift towards metrics like real economic value, or RV, things like base fees paid by users, genuine activity, not just inflated transaction counts.
Okay, so substance over pure hype. Did they mention any specific examples of chains showing this kind of fundamental strength?
They did cite a few interesting ones based on these metrics. One was Hyperliquid. Apparently, it saw a massive 95% surge in DX volumes recently, doing around $1 million a day in fees. And what's compelling there, besides the volume, is its market cap relative to those fees. Around a 40x multiple, which is tiny compared to the thousands you see for some other big blockchains.
40 times fees. That sounds reasonable, relatively speaking.
Yeah, and they also highlighted its launch model, a fair launch. No VC pre-sales, tokens distributed directly to the community. That kind of structure seems to be gaining value in the market size. More decentralized, maybe healthier.
Interesting. Any others?
Yeah, BNB was mentioned as picking up significant activity again, showing resilience, user growth in its ecosystem, and, maybe surprisingly, Tron. It was noted for having really strong fee generation, around $9 million, mostly from stablecoin activity, plus low volatility and a big token burn mechanism.
Tron, huh? So
Oh,
these examples aren't just meme coins. They're platforms showing actual usage and economic throughput.
that's the point they were making. These are examples of where capital might be flowing because there's demonstrable underlying activity and value capture, not just hope.
That shift, if it holds, feels genuinely profound, moving from pure speculation towards towards fundamentals. So yeah, meme coins will still grab headlines, capture capital, and burst, no doubt. But the broader trend, the smarter money perhaps, might be less inclined to just throw cash at the bottom tier projects without some real substance underneath. It really does sound like a maturing market.
It does feel that way, doesn't it? More discerning.
So let's wrap this up. To summarize the key lessons for you, the listener, navigating this crypto market.
Okay, first, absolutely prioritize global liquidity trends. We've hammered this home, but it bears repeating. It's the main macro driver. Watching those expansion and contraction phases is just paramount for the big picture. It's the tide.
Right. Lesson 1, watch the tide.
Second, use a multi-factor model. Don't just rely on price. Employing a comprehensive risk framework like the Couts model we discussed, covering liquidity valuation, derivatives froth, and on-chain health gives you that much-needed depth. It helps you assess positioning, avoid stepping on landmines. It's about understanding if the engine's running too hot, not just the speed.
Get under the hood, basically.
Exactly. And finally, lesson 3. Fundamentals seem to matter more now, especially for alts. Understanding network growth, real economic activity, fee generation, it's becoming crucial. Discernment is key. It's not just about riding a wave anymore. You need to understand the actual currents driving specific projects.
Fundamentals over pure speculation. Okay, great summary. Now for a final thought, something provocative for you to mull over. The discussion between Raoul and Jamie touched on something interesting. The idea that global liquidity contraction periods might be getting longer. This cycle, they speculated, could potentially extend well into, say, Q2 2026. So consider this. What does a potentially longer, more drawn out, more discerning cycle mean for how you approach your crypto investments? Does it change your time horizon? Make you focus more on sustainable projects? Maybe even income generation within crypto? How does this potential for sustained growth, combined with the need for patience and fundamental analysis in a maturing market, reshape your strategy moving forward? Something to think about.